Welcome to the debate. We are diving into a major policy shift currently underway in Indonesia. The government's imminent regulation that mandates e-commerce platforms, we're talking about the huge ones like Shopee, Tokopedia, TikTok Shop, they must now act as tax collectors for their vast network of merchants. And this isn't just a small administrative tweak, it really signals a fundamental restructuring of how the state interacts with its booming digital economy.
And this policy has, it's generated significant friction. We are talking specifically about the requirement for these platforms to collect income tax, known locally as PPH Pasal 22, from sellers whose annual turnover is pretty substantial. That's the bracket between 500 million and 4.8 billion rupiah. Now, the government insists this is merely a shifting of the tax payment burden, not a new tax rate. But, the complexity of the implementation and who exactly is being targeted, that's what concerns me most.
Absolutely. Which brings us directly to the core tension we need to explore today. Does mandating e-commerce platforms to collect this PPH from millions of micro, small, and medium enterprises, or MSMEs, does that primarily achieve the necessary administrative efficiency and compliance for the domestic economy? Or, conversely, does this narrowly focused approach risk major market disruption and ultimately fail the broader test of fiscal justice by, deliberately overlooking the revenue extracted by massive global digital giants?
I'll be arguing that this policy, while it claims to seek fairness, is fundamentally partial. It creates a glaring, immediate fiscal injustice for local sellers and carries, I think, unacceptable, high-stakes risks of disrupting the critical MSME sector that really defines the local digital economy.
And I'm going to contend that this is not only essential, but long overdue administrative reform. It is, frankly, the only practical way to ensure tax parity between online and offline businesses and a necessary step to stabilize national revenue in an economy that's digitizing faster than the tax authority can even track it. So, let's start with the fairness proposition. This mechanism is a critical and, I believe, fair step forward for Indonesian fiscal policy. The primary objectives, as stated by the Directorate General of Taxes and the Ministry of Finance, are pretty clear. They want administrative simplification, increased compliance, and genuine fiscal fairness, what they're calling a level playing field.
Okay, I understand the desire for a level playing field, but I see why you think that, and yet I come at it from a very different angle. If the true goal is fiscal justice, this policy is structurally partial. We're focusing this massive new administrative burden on millions of small digital MSME sellers. Groups like the Indonesian E-Commerce Association, IDEA, are right to demand cautious, phased implementation because these sellers are the absolute backbone of the local digital economy, which, by the way, saw a staggering gross merchandise value, or GMV, of roughly $64 billion just last year. Risking that engine of growth for narrow compliance gains is, to me, a dangerous trade-off.
But that fairness principle can't be ignored. We can't allow this enormous shadow economy to continue expanding simply because commercial activity happens online, shielded from effective oversight. The Vice Minister of Finance has repeatedly confirmed that the intent is to create identical tax treatment between online and offline trade. Physical retailers are already subject to this specific income tax rate for small businesses, the PPH final UMKM. Why should digital sellers earning similar revenues be exempt just because the DJP struggles to track their sales? The platforms provide the data needed to close that very gap.
That's true. The platforms do have the data, but let's talk about that gap. While you're focusing on the domestic shadow economy, which certainly needs addressing, my core issue is where the government chooses to focus its collection efforts first. By targeting only local marketplace activity, the domestic UMKM, the policy fundamentally ignores the truly massive, disproportionate revenue extracted by global tech giants, Google, Meta, Apple, Amazon.
Those are entirely different revenue streams, though.
They are, and that's the point. Those multinational entities operating in Indonesia, they only pay PPN PMSE. That's a consumption tax on foreign digital services, which is frankly easy to collect. They don't pay a proportional corporate profit tax on the billions they extract annually from the Indonesian market. So when local MSMEs are forced into a complicated new PPH collection structure, while global entities extract value virtually tax-free on profits, that just feels like the very definition of fiscal injustice, and it completely warps the market optics.
You have to crawl before you can run, though. We need to stabilize the foundation, and that means cleaning up the domestic tax base. And that leads us directly to the practical mechanics, the supposed administrative ease versus the operational reality.
Exactly.
From the perspective of the individual taxed MSME, this new system fundamentally makes life easier. Instead of the merchant having to calculate, report, and manually pay their PPF final UMKM, which is often a complex, annual burden they fail at, the platform just automates the deduction at the point of sale. That shifts the entire compliance responsibility for millions of often untrained merchants to a few large, technically capable e-commerce platforms. This is administrative genius aimed at enhancing national tax compliance. And remember, the 0.5% rate isn't new. It's mandated by the existing government regulation.
The operational risks are immense. This is simplification for the tax authorities, sure, but it's massive complexity for the platforms. The e-commerce companies themselves are already voicing concern about the increased administrative and liability burden.
But using the e-commerce platform as the collection agent is exactly what experts recommend. It's the key, agreed-upon solution globally to addressing the low tax ratio problem that stems from difficulties in monitoring this enormous informal sector. The platform has all the transaction data. They are uniquely positioned to automate this.
Automation only works if the technical integration is flawless, and that is where the government's plan feels, shaky. For this system to succeed and track that 4.8 billion rupiah threshold correctly, it demands really complex data synchronization, especially because sellers often operate multiple stores across different platforms. Maybe one on Shopee, one on Tokopedia, another one on TikTok Shop.
So how do you track that aggregate turnover?
You have to aggregate it perfectly. And that requires mandatory use of a centralized identifier, the Business Identification Number, IB, or the National Identity Number, NIK. If the systems can't flawlessly communicate and aggregate sales across competing platforms, a seller could easily exceed the tax threshold on aggregate sales while remaining below it on each individual platform, and that leads to undercollection or, worse, arbitrary penalties. Given that the government's own tax system faced technical issues after a recent upgrade, the industry's skepticism about robust, ready integration is entirely warranted.
We can't let technical inertia stop vital reform, though. Yes, there must be robust socialization and rigorous testing, but this aggregation challenge is solvable with proper governance.
Maybe, but history offers a very sobering lesson here. We have to remember that a similar regulation attempting to tax digital transactions was introduced back in late 2018, and it had to be completely withdrawn after only 3 months. Why? Because the technical framework was immature, and there was massive industry pushback and confusion due to a complete lack of socialization. If this new policy rushes implementation without ensuring platforms have the technical capability and merchants understand the new reporting chain, resistance and outright non-compliance will spike, not compliance.
That cautionary tale is acknowledged, but this current effort is far more targeted and structured around existing law. Let's move to the economic argument and the actual impact on the MSMEs. The policy explicitly shields the most vulnerable. Merchants with turnover below 500 million rupiah annually are completely exempt from this PPH final. That threshold is not accidental. It's the government demonstrating a clear intent to protect micro-businesses while ensuring those who are firmly established, earning up to 4.8 billion, contribute proportionally. And since this is an existing tax merely collected differently, fiscal experts largely agree this will not make for economic contraction because the liability was already there.
That's a key distinction you're making, that the liability was already there. But I'm not convinced that the simple shift in mechanism avoids disruption. It's a psychological hurdle as much as a fiscal one. Industry reports are suggesting that this direct involvement of platforms in tax collection could potentially reduce MSME participation in e-commerce by up to 26%.
Why such a high exit rate? If they're successful enough to hit that 500 million threshold, the 0.5% collection is marginal.
Because for many, the administrative friction creates an immediate disincentive. They fear increased scrutiny, And the need for formal registration, that Nibinic linkage, might reveal other untaxed activities. This displacement is alarming. Sellers won't just stop selling, they'll simply revert to less formal channels, like direct sales via social media, or moving entirely back to conventional physical stores where the tax authority has even less visibility. We are inadvertently just pushing the shadow economy sideways, not eliminating it.
But that defeats the whole purpose of being on a platform, which offers trust, payment gateways, logistics.
Precisely. Then this displacement is happening against a really tough economic backdrop. Analysts have already linked recent declines in site visits to major platforms in April 2025 to a general weakening of public purchasing power and widespread layoffs across various sectors. Now you risk the exit of millions of small sellers, who, by the way, form the sweet spot for digital advertising and brand partnerships that rely on that long tail of UMKM activity. Disrupting their presence creates deep uncertainty not just for the platforms, but for the entire $65 billion GMV digital ecosystem that relies on these transactions.
We have to maintain perspective here. This policy aims to raise compliance from, say, 60% of turnover to perhaps 80% over time. We must close the domestic tax gap, which currently contributes heavily to Indonesia's low tax ratio relative to its GDP. While MSMEs are crucial, fiscal balance requires that we move those above the 500 million threshold toward formality.
Moving them toward formality is laudable, but doing it in a way that feels unequal is counterproductive. And that brings us to the truly contentious issue, the unaddressed imbalance, the issue of global fiscal sovereignty. The government's approach here is being heavily criticized by economists. They argue that by focusing exclusively on local marketplaces and MSMEs, the policy deliberately glosses over the massive, non-resident revenues extracted by global digital firms. It's a deflection, really, focusing on the easy target.
I think it's unfair to say they're ignoring it. We have to address domestic compliance first. You can't build a robust state revenue system if the domestic foundation is porous. Furthermore, the government is being prudent by waiting for the OECD's multilateral consensus on a digital services tax, or DST.
Prudence?
Yes, taking unilateral action on a DST, imposing a tax on foreign tech revenue derived from Indonesia, carries serious, proven geopolitical risks. The U.S., for instance, previously threatened tariffs against countries like Canada, France, and Turkey when they pursued unilateral DSTs. The current policy is a pragmatic, necessary initial step to clean up the domestic shadow economy without provoking international trade wars.
That's a compelling argument for international caution. But have you considered the economic optics within Indonesia? By choosing the safe route, only imposing PPN, PMSC, that easy consumption tax, on global players, Indonesia risks confirming its status as merely a market. Global giants like Google and Meta extract massive digital advertising revenue and profit, which then flows overseas without a proportional corporate profit tax contribution within Indonesia.
They pay PPN on the services sold here.
They pay a consumption tax, yes, but they do not pay corporate income tax on the profits derived from Indonesian users, which is the revenue stream we are discussing when we talk about fiscal justice. Economists rightly point out that Indonesia is prioritizing ease of collection over true fiscal equity.
But we must weigh the immediate domestic gains from compliance against the volatility of international trade sanctions.
Fiscal sovereignty, I believe, requires a different kind of courage. Look at Canada. They understood the risk of retaliation. They faced opposition directly from the U.S., but they went ahead with a unilateral 3% DST on global tech revenues. They did that to take a stand and capture value earned within their own jurisdiction. Without Indonesia taking a stand against this massive global imbalance, local UMKM sellers, who are now facing new complex compliance burdens under this PPH policy, will inevitably feel what they call dizalimi, oppressed by their own country.
I understand the feeling, but the government is making a clear choice here. They are prioritizing a manageable, high-impact domestic reform that addresses a known, fundamental flaw in their tax administration. This is achievable now. Engaging in a diplomatic battle over an international tax framework that is still evolving at the OECD level is a distraction from the immediate need to fund national development.
It may be a distraction, but if the foundation of domestic compliance feels unfair because the biggest players are exempt from proportional taxation, that corrosive narrative will undermine long-term tax morale and compliance efforts among the very MSMEs you're trying to regulate.
You can't achieve true fairness by addressing only half of the problem.
Ultimately, the core objective remains to ensure that the enormous growth of the Indonesian digital economy, especially the successful UMKM sector with turnover exceeding 500 million rupiah, is accompanied by proportional tax compliance and a level playing field with conventional businesses. By integrating the PPH collection directly into the marketplace system, the government is delivering a highly efficient mechanism for closing that domestic shadow economy gap. The success of this really hinges on careful, transparent implementation and clear communication with both the platforms and the millions of affected sellers.
And while the stated goals of administrative fairness and increased compliance are indeed laudable, the policy fundamentally addresses only a partial segment of digital revenue. It places the administrative burden and significant potential market risk squarely on the local digital ecosystem. Its success is entirely dependent on robust technical system readiness and comprehensive socialization to avoid the resistance and market dislocation we saw in 2018. Crucially, the larger unresolved challenge of achieving true fiscal justice by securing proportional profit contribution from non-resident global digital firms, that remains a significant question mark over Indonesia's long-term economic sovereignty.
We leave the audience to consider whether administrative expediency in securing vital domestic compliance should take priority over the difficult yet necessary call for structural fiscal equity in this rapidly evolving and highly complex digital ecosystem. Thank you for joining us on the debate.